Good morning, ladies and gentlemen, and welcome to the DP Poland Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you'd like to give that your kind attention, we would be most grateful. And I'd like to hand over to the management team from DP Poland. Good morning to you all.
Thank you, Mark, and good morning to everyone. Mike nicely avoided pronouncing my first name, but I'm Przemek Głębocki. I'm non-executive director of DP Poland. It's our pleasure to meet you on this webinar. We got a lot of positive feedback after the first webinar that we held in July, and as promised, we would like to keep this communication with you and allow also to ask you questions. So you may have seen that we have published the results for the first half year, and also we made a trading update that was published on our website. We have a presentation that you could see, but we'll also provide additional comments to it. But before we dive into it, maybe a short introduction on who is today with us on the company side. As mentioned, I'm Przemysław Głębocki. I'm a non-executive director of DP Poland. I'm also a co-managing partner of ACP, which is representing the largest investor in DP Poland, holding 45% of the equity. And in addition to this, I'm also the president of the Polish Private Equity Association. My history with the company is that we invested in Dominium, as you may remember. We completed the reverse takeover, and we have swapped the shares of Dominium into the shares of Domino's Pizza Poland, and here I am as a non-executive. But we have more important people on this call. These are the two executives, the CEO, Piotr Dzierżek, and Małgorzata Podkańska, the CFO. And I will hand over to Piotr for a short information about his background for some of you who have not participated yet in the webinar so far. Piotr.
Thank you, Przemek. Good morning, ladies and gentlemen. My name is Piotr Dzierżek. I am the CEO of Domino's Pizza Poland. I joined the board in January this year. I was previously with Pizza Dominium for 20 years. I started as a regional manager responsible for overseeing Dominium's 15 restaurants at that time. Next, I was promoted to general director. My responsibilities included purchasing, operations, office administration, and oversight of IT. Finally, in 2018, I became CEO. I started my career in Carrefour Poland when I was responsible for purchases and price management. Thank you, Małgosia.
Thank you, Piotr. Good morning, ladies and gentlemen. My name is Małgorzata Podkańska. The shorter version of my first name is Gosia. It's also easier to pronounce. I am the CFO of DP Poland, joined the company in January 2021. Previously, I've been a CFO of Dominium for 4 years. And I started my professional career in finance and audit department at PwC. Thank you.
Thank you, Gosia. So now moving on. As mentioned, you probably have seen the financial performance of the business in the first half year. However, before we dive into it and we ask Gosia to guide us through those numbers, we wanted to share with you a bit of more operational update and information about what has been accomplished. We do that because we think that the financial statement for the first half year does not really present what was the true performance and what really happened in the business. This is mainly this is because of the 3 reasons. First of all, as you know, the transaction, the reverse takeover was completed on the 8th of January. So since then, there was a number of activities that were related to the conversion of the Dominium business and the merger of the two. So we had many one-off costs. Some people left the firm. We had to buy more equipment. Not everyone could be capitalized. So there are many exceptional items in this first half of the year, since this was 6 months of constructing the business as it is today. So that's one. The second was about the lockdown. The first half of the year was still heavily affected by the lockdown. You may remember that we anticipated the lockdown to continue, of course, but it took longer than anticipated, which had an impact also on the P&L. Now it's no longer the case. And thirdly, there are some accounting specifics that make this a bit more difficult to read. That's why we have also presented an additional column to give you more comparison. But before we dive into the numbers, I wanted to give floor to Piotr to comment on the operational achievements that were done in the first 6 months. When we made a summary of what has been done and completed, Piotr will summarize it even further, but the volume of work was immense. So I will hand over to Piotr now, and Piotr will guide us through those items. Thank you.
Thank you, Przemek. When I was preparing this slide summarizing the integration, I have realized that it is not easy to present briefly many months of hard operational work. Even if I say that we had to enlarge 28 the walk-in chiller rooms, we had to reorganize 54 make lines and install 177 new larger refrigerators, I cannot express how huge effort the whole team made. Simply, I just want to report that the integration is complete. First of all, thanks to the merger, we were able to redesign the delivery areas. As a result, in cities such as Warsaw, Wrocław, Kraków, we have been able to shorten the delivery time. We already have a leading position in Warsaw, but small delivery zones help us to start, let's say, groundbreaking project that will allow us to achieve an average delivery time of up to 20 minutes. I have to mention that none of the catering companies in Poland offer such a short delivery time. So we want to build our competitive advantage on this and become a pizzeria of the first choice. We have built the combined menu on the best-selling items from both companies. The most important of these are new types of pizza, fresh salads, but also pizza made from whole grain dough. And the biggest novelty in Domino's offer...
Remember that competition may be listening to us, so don't reveal all the secrets.
Okay, I do my best. We want the 16 pizza is a normal fact. So when I met sub-franchisees and store managers at the start of the merger, they were very pleased with the implementation of the biggest pizza, especially in the smaller towns. In Poland, large size of pizzas are very popular and are considered the most economical. So in Domino's, the XXL pizza also wins in the sales ranking. After the merger, we have a fully refocused supply chain. One of the major changes was the termination of cooperation with Coca-Cola and the introduction of Pepsi-Cola product to the combined business. As a result, it was possible to improve general trading conditions by almost, I can't say how much, but it was significant improvement. Referring to headquartered, we have successfully integrated both teams using the best talent from both organizations. We had to unify the remuneration policy, which unfortunately resulted in some people in headquarters leaving the organization. But now we are happy to report that we have a stable and dedicated team for the future. Referring to marketing synergies, we have implemented a digital experience platform and launched a new website and new smartphone app for placing orders. We have merged many marketing functions and areas, including Google Analytics and Google Ads. Our stores are now fully integrated with the website, the Android and iOS, as well as with the central data warehouse. As a result, we have been designing customer segmentation models and applying marketing automation. Following the decision from preliminary analysis, we took over 17 stores from franchisees. Our primary focus now for the coming months is on improving the performance of all stores. And when the stores reach satisfactory KPIs, we will offer some of existing locations to new franchisees or existing franchisees. At the end of this slide, I would like to say that the biggest challenge was IT integration. Due to the serious problems at virtually every stage of implementing the new IT system, the completion of the integration was delayed by a few months. But finally, I can report that we are fully plugged into DPI's system, allowing for analysis of business and the enforcement of the best practices. Thank you, Przemek.
Thank you, Piotr. And now moving on to the next slide, which shows the summary of the 6 months. And as I mentioned, I mean, the picture is a little bit imperfect, but it is perfect from the accounting perspective, and it was reviewed by the auditors. So I will now ask Gosia to guide us through these numbers and maybe to give you a bit of more flavor and color on what they stand for. Gosia.
Thank you, Przemek. Ladies and gentlemen, I will talk a bit about those magic numbers. So a few words of introduction. As per IFRS 3, it was Dominium SA that has been identified as the accounting acquirer. Therefore, the comparative data in the middle column of this table stands for Dominium SA only, as those are the IFRS 3 requirements. But for illustrative purposes, we've made an unaudited pro forma consolidation of H1 2020 comparative data, and you can see this data in right-hand side column. Our original plans were more optimistic on the numbers, which during H1 2021, as Przemek already mentioned, were highly affected by unpredicted COVID-19 restrictions, but also by delay in IT integration, which restrained full conversion until 8 July. COVID-19 has affected the business as we were observing migration of our customers from big cities like Warsaw or Krakow during the lockdown. Also, schools, universities, and offices were online learning or on home office. Additionally, the H1 2021 numbers are affected by substantial one-off integration costs like advisory costs or Dominium stores conversion costs, which could not be treated as CapEx and were expensed in the P&L. Thank you.
Thank you, Gosia. Now moving on, Piotr was to the next slide. Piotr commented on the items that were on the agenda and on an action plan for the first 6 months, and they were completed. And as you could hear, only the IT integration was delayed. But other than that, we were on plan. However, there was also a number of factors in the market that affected us that we didn't plan for. These items are affecting everyone, and we are dealing with them, and I think we have very good answers, and we know what to do. But just to give you a little bit of a flavor of what's going on in the marketplace, we have prepared those few bullet points, and Piotr will guide us through those as he's dealing with this on the daily basis. Piotr, handing over to you.
Thank you, Przemek. We initially anticipated cost synergies to come from lower prices of raw materials. Unfortunately, the reality has proven to be different. As you can see, almost 6% of inflation rate in Poland has not allowed for reduction in the cost of raw materials. On the other hand, without doubling purchasing power, our situation could be even worse. I remember an email from our pepperoni producer who informs that in the current difficult situation, they can apply only slight price reduction, which is related only to the increase in the purchase volume. In response, we raised our sales price in June, and we are planning another soon. Maybe not a typical price increase on the menu, but a reduction in promotions or the introduction of paid deliveries. We anticipate further increases in prices. That's why we constantly negotiate terms of cooperation with current suppliers, and we are looking for new producers. Another challenging factor is that in Poland, the unemployment rate in August was only 3.4%. What more, social programs implemented by the government and the constant increase in the minimum wage have made it very difficult to recruit new employees. To mitigate this, we are constantly increasing the employment of foreigners, especially from Ukraine, whilst at the same time shifting our process activities to online channels. These economic facts and lockdown have changed customer behavior. It can be said that our business model is COVID resilient. We stand on two strong legs. It means during the pandemic, customers quickly changed their habits and began ordering more frequently with delivery. But post-lockdowns, we offer our clients a restaurant offer with a wide menu and waiter service, and giving the best experience. Encouraged by this good experience in the restaurant, our clients want to order our pizza for home and office. By the way, sales to offices even after lockdown is still practically not existent. Most companies noticed the benefits of working remotely and decided not to return to work in the traditional model. The situation is similar with tourists. According to recent reports, Warsaw was visited by 75% less and Kraków even by 80% fewer foreign tourists than in 2019. In response to this, we closed periodically selected restaurants during the lockdown. As a result, we reduced the number of staff. The necessary team simply needed to handle orders. I have to mention that the competition in the food delivery market is also bigger this year than in the first wave of COVID-19. Most companies, even those associated so far only with the restaurant offer, have decided to sell their product also with delivery. For this reason, we are constantly monitoring the activities of the competitors and maintaining our promotional offer at an attractive level. Thank you, Przemek.
Thank you, Piotr. I mean, I would also allow myself to comment on this, and I also see questions coming our way, so I'll try to also address those questions in my comments. First of all, Piotr did mention, we have this market developments that are not favorable to us. However, actually, the paradox could be they are not that bad as well, because of course this is not something we would wish for, but like in inflation or the low unemployment. However, with the size that we currently have, we are by far the best position in the market to tackle those. So if we, like Piotr mentioned about the replacement of Coca-Cola with Pepsi, we are one of the few businesses that did well, or relatively well, during the pandemic. You will see very shortly that our sales were doing relatively fine, whereas the HoReCa market did suffer. So we became very important clients for many suppliers. And when the small stores with a small volume are price takers, we can negotiate those terms. Same with low unemployment rate. With the low unemployment, on one hand, we have a difficulty in hiring people, but at the same time, our network helps because we have a big network. We'll cover this very shortly. So our distance to customer is the shortest, so we can deliver relatively quickly, which means we need fewer people to deliver the same products because our network is very dense. On the erosion of client groups, yes, this is something that affected us, but in particular in the first 6 months, also in the summer, but now it's coming back. We will very shortly present you the October figures. So despite still those market developments, we're doing really well. Looking especially at the very recent data. The very recent data is relevant because we see that the university year started, but we'll comment on this shortly. Addressing a question from Michael, whether we have experienced any form of supply chain issues, and if so, how have we mitigated these? We didn't have any disruptions. The executives are working closely and monitoring the situation. We have replaced the logistics with third-party suppliers, so we keep watching what's going on, but we don't have any disruptions. It's more about the inflation that Piotr mentioned on this slide. We constantly monitor the best prices, we react to it, not only sort of on the cost side, but also on the revenue side. And then Piotr also mentioned the price increase, but we have more instruments to tackle this particular topic going forward, but we can comment on this in the next slides. So moving on to the next slide and about the current trading update, about 9 months and the 3 months in particular of the third quarter. But I will hand over to Gosia to comment on the dynamic, and then also get us ready for the following slides that discuss EBITDA performance and then the very recent trading of October. Gosia.
Thank you. Again, a few words of introduction on what you see in the tables. System sales is sales of all Domino's branded stores, so both corporate and sub-franchise, and both Domino's and Dominion by Domino's. As you can see, system sales for 9 months 2021 is still 5% below 2019, but meets 2020 numbers. Like for like increased versus 2019 and 2020, and what is even more encouraging, that in 2020 the COVID restrictions hit us only for 3 months for the period between March until May. So the period of restriction was much shorter than in 2021. We still observe slight drop in dine-in sales in comparison to 2020, and double-digit drop in comparison to 2019, so the pre-COVID environment. But we observe the dine-in is still recovering, and we are pretty confident we're gonna reach the 2019 numbers soon. The integration of 2 businesses took final place on 8 July. But during H1, the 2 businesses were still operating in parallel, which means we had to direct our marketing efforts to 2 brands. Also, the delivery areas remain unchanged and they were overlapping. Okay, so we showed you the statistics for 9 months, and the bottom table shows only Q3 statistics. And it is much better than H1 2021. We're growing in both dine-in and delivery. We observed some churn of Dominion customers from Domino's website, because currently after entering Dominion website, our customers are being redirected to Domino's website, and some of them were resigning from ordering right after being redirected. This was already addressed by us. They got additional promotion, and now we see that they are more convinced to place an order. We've also built combined menu, what Piotr has already mentioned, but some of our customers couldn't find their favorite pizza flavor under old name, and they were also migrating from the site. But again, the additional promotion has encouraged them to go through the menu. What's more, the redesigned delivery areas impacted delivery times as our drivers had to learn new routes. But on the other hand side, we noticed improving loyalty of our customers as they smoothly migrated from dine-in to delivery during lockdown periods and the way back when the lockdown restrictions were removed. So we don't charge extra for the delivery, which was already mentioned by Piotr. Which makes the delivery not as profitable as dine-in. I think it's not too much to say that our business has become more resilient to any future worsening of COVID pandemic. Thank you.
Thank you, Gosia. I would also refer to a question about, at least half of the question, about the competitors. What's happening on the competitive landscape? Do we see the bolt-on opportunities in distressed pricing levels? Well, yeah, that's a good question, and it's probably fair to answer this at least partially on this slide, because partially we'll answer this in 2 slides from now. But it's fair to say that we expected better performance in the 3rd quarter of the year. However, it proved to be well. It's maybe not as bad as one could think, because in general we are doing much better than the competitors. We see then we are a very strong player in Warsaw metropolitan area. And as you may imagine, after months of lockdown, people, when they could go out and go for holidays, and in the summer months, they basically left the city. And we see that there are many other businesses in Horeca that do suffer. And I sit here in the office building in the very center of Warsaw, and there's a shopping mall downstairs, and there are many stores that are closed, which creates for us opportunities in terms of rollout, but also acquisitions. We are in talks also at the very preliminary stage to buy a chain. We sort of disregarded this in the past, but we now see that this is an opportunity because other businesses, other competitors are really bleeding. I was saying that we are not that happy with the 3rd quarter dynamic of 3% growth, but in fact people are suffering much more. The other phenomenon that is maybe worth mentioning here is that if you sort of divide these numbers for Warsaw and the other cities, you will see that we are growing very fast in cities outside of Warsaw, and Warsaw is performing worse. Why it is performing worse? Because people are most affluent. So in the summer months, they just left Warsaw. After the months of lockdown, they went out. We didn't have students, which is our big target audience. They were working online, they were studying online, so they were not here, and we didn't have customers. So in this sort of adverse circumstances, we still maintained our client base. However, we are quite optimistic because we do see that this has come back to the levels we would expect already in October, and it proved to be the case that our like-for-like sales are not really like-for-like, because we are comparing sales in sort of empty city to sales in a full city, and we'll show you this on the slide about October sales. And then a little bit more about the other topics about the competitors we will mention maybe in a few slides, because I think we have a slide on that also answering some of the questions we got before. Moving on to the slide about the profitability and EBITDA performance, Gosia, maybe handing over to you.
Yeah, thank you. What we wanted to show you on this slide, and the graph is only for illustrative purposes, is that our EBITDA represents clear positive trend over the last months. It also shows the learning curve. You would probably ask about what happened in Q1. So the drop down in Q1 was due to the delay in IT systems integration, which blocked us from full integration of two businesses. Additionally, again, the pandemic restriction also affected the numbers as dining was loss-making during this period. The restrictions were tighter during this wave of pandemic. The lockdown was much longer. Our customers migrated from large cities. There was a significant decrease in the number of foreign tourists in cities like Warsaw and Krakow, which was already mentioned by Piotr. We were also not eligible for any substantial state support during this pandemic wave. What I have already mentioned is that we incurred substantial one-off integration costs, which could not be presented as CapEx over the period of January till August. Thank you.
Thank you, Gosia. And now moving to the slide that everyone wanted to present, but we gave the floor to Piotr. So Piotr, you have the privilege of showing this slide that makes us so excited.
Yeah, it's true. Everyone wants to present the slide like this. So when we look at the trading performance in the first days of October, we can see how our process activities are bringing benefits. The charts show double-digit like-for-like growth compared to 2020 as well as 2019. Taking advantage of the moment when students officially go back to universities in October, we have launched a marketing campaign beginning in Warsaw on billboards, posters, public transport, and radio. Additionally, thanks to tailor-made promotion, we have reached specific customer groups. As a result, since the implementation of the new website, the number of website visits has increased by 27%. All these show that there is potential in the combined business that we are just exploring, but I don't want to be selfish, so I think, Przemek, you would like add from your side something to this slide.
Thank you. It's a pleasure to discuss this slide. But I think that slide makes us really excited for various reasons. But I started to mention why it's the case on the previous slide, because we looked at like for like, but in fact these are not like for likes, because we're comparing as I said, empty city to the full city. Now we see what's happening when students came back. Warsaw is a big academic hub. I mean, it's the capital of the country, and as you can imagine, it attracts many students and has good universities. And students are a big part of our audience. And if we're talking about growth rates, then every customer matters to us, obviously. So now we see how the situation looks when it's almost back to normal. I would say it's still not back to normal, because in my office building, I see it's still half empty. So I think there's room to improve further when people are gradually coming back. We think it will be probably new normal, so it will not be as it used to be. I mean, we all probably see that the hybrid office working model, so a few days in the office, a few days at home, but people are gradually coming back. In addition to this, the economy in Poland is doing quite well, and there's a lot of office buildings. There are many office buildings that are constructed. Just next to me, there is a tallest office building in Europe being constructed, and then this will be open soon. So this will also provide us more and more demand for our products. And we, with Domino's Poland, we are very strong in big cities. So it's not fully like for like, but this gives you a snapshot of what happens when students came back, what happened to us. Piotr also mentioned, so that's the first. It's more like for like than the other ones, because the other ones were not really comparable, we think, based on what we see now. The other comment that Piotr, to comment on what Piotr mentioned, was that these are sales for the first days of October, but we are in November already, and we know that the trend continues. So October is a really strong month for us, not only on the sales perspective, but also on the margin perspective. And then also referring to the previous question about the competitors, Competitors were bleeding, and some of them closed down. We see many stores that are closed down, and now we see the benefit of this. You know, when people came back, when our customers came back to the big cities, now we can show the growth rates. Commenting on the two slides, I think two important. I wanted to flag two important topics. When you look at the bottom slide, or the bottom sort of graph, you see the delivery growth. We were asking ourselves a question: what happens after the lockdown is over? We knew we were doing quite well. You could see on the previous slide in the delivery, we kept our client base, we kept sales, but delivery was growing very fast. And we thought, you know, when people are allowed to go out of their homes, of their houses, and they go to the streets, maybe they stop buying on delivery. But it's not the case. That's a very important point to make here. We are still growing on 5.5% versus 2020. However, you see what happened to the dine-in. You know that Dominium has this flagship stores in quite attractive areas in largest Polish cities, in Warsaw, Krakow, and Wrocław, and other places. And you can clearly see that, you know, when the lockdown measures were lifted, people went out and we captured them with our dine-in. So that's quite an exciting thing, and this is our second leg. I don't think it were sort of COVID-proof, but that shows, you know, that that our clients stay with us, whether they're on delivery or on dine-in, but also that the client base is growing. You can see that 30.8% growth to 2020 and 26% growth 2019, because we are benchmarking ourselves versus 2019, which is pre-COVID. The 2020 had number of drivers that could impact the performance. That's why when we evaluate ourselves, we are benchmarking the performance to 2020, but also 2019. And there is another very important point I wanted to make. Comparing to the pre-COVID levels, we are growing on dine-in, 1.2%. I mean, it's not huge growth, but given the fact that we still have no tourists, so few tourists coming to the largest Polish cities, in particular Krakow, taking into account that offices are working still in the hybrid mode, and people until the end of the year will still probably not be fully back. I think this is quite an important achievement, that even dine-in is growing. And just next to it, you see the delivery sales. So how much progress we made versus 2019 in delivery. That shows the strength of the business. I'm looking at the questions whether we can. There's a question about the comparison of the Domino's, the old Domino's stores and old Dominium stores. I mean, what's the difference and how they mature. At the very beginning of the process, we made it very clear that we will not refer to the old Dominium or Domino's stores. These are all our stores. These are all Domino's stores. Some stores work under Dominium by Domino's as a transition brand, as we mentioned this on the previous webinar, but it's all our stores. I mean, as you know, in the merger situations, it's difficult. People still think in the old categories, what is ours, what is theirs. We have cut through that, so we're not comparing this to the past performance. We are looking at the entire network. We have redesigned delivery areas, so we are delivering from the places we think we thought are the best. This is also likely to change, because now we can undertake a lot of improvement in the efficiency based on the sales that we have done so far. On the topic regarding the maturity and the profitability, there is another question about that. We see already in October that our profitability is much stronger. October shows us very good data also on the cost side, given the economies of scale and so on. But there's much more to do. On the store network, maybe I can move to the next slide, which shows the market developments, and I will come back also to the question that we got from Peter before. You may remember that we were showing on the previous webinar and the previous discussions our size in Poland versus competitors. And then this was the slide on the graph on the bottom. It shows 119 stores, but the fact that we have 121 stores because there are 2 stores that we operate at the seaside, and they are seasonal restaurants, so they operate only in the summer months. But then it looks like we're number 3. However, when you dive into the particular markets like Warsaw, which is the biggest city in Poland, then you see that we are already the dominant player. And it has and this is basically following the best practice of Domino's International. As you know, I mean, the Domino's has been very successful in places where it's a dominant player. And this is the case already in Warsaw. It has a number of implications. First of all, the research shows that people are buying from the stores that they see more often. So the size of the network can help to generate leads and customers. So because they know the brand more, they trust the brand, so being larger helps. However, that helps to the largest benefit is related to the cost of delivery. Our distance to customer is the shortest because our network is the most dense, and we have more stores than anyone else in Warsaw area. So our distance to customer is the shortest, which means we can deliver, I mean, as everyone knows, I mean, the best pizza tastes awfully if it's cold. So we can make customer happy by delivering good quality and hot pizza. And also when people order, people are usually hungry. So we are the fastest. But the fast and the short distance means also we are the cheapest, because if our drivers cover short distance, they can do more deliveries per hour, and that may be much more efficient on the hourly basis. So that's an important element. When we merged the two businesses, I mean, these were the two parallel networks. So there were many overlaps, and we decided to redesign delivery areas based on our best judgment. However, this has to be tested. And now based on October figures, we will redesign the delivery areas in order to improve the labor cost and also to shorten the distance to customers. We couldn't do that before because the data was not comparable. I mean, in the summer months, I mean, when people were out of big cities and we had no students, if we draw conclusions on that data points, we would draw wrong conclusions. And we are not doing this for the short period, we are doing this for good. So we want to reevaluate delivery areas based on October figures. But that's tying to this big unique advantage we have, which is the size of the network in Warsaw. When you look at other cities like Wrocław, Krakow, and the others, we are also a very strong player. Where we are not strong are the second and third tier cities in Poland, and you can see here the competitors of us, which is Da Grasso, which is a local chain. We think we will unstable quality, but they are present in the smaller towns and cities, and this shows the potential for us to grow. When you look at the other competitors, you know Pizza Hut, of course. I mean, they are located a lot in shopping malls. They're relying on the dine-in, and then I mean, because of the COVID and lockdowns, they do suffer more than us. So we think we are in much better position. We don't want to say badly about the competitors, but we feel quite confident about ourselves. Telepizza, you know the story of Telepizza globally. I mean, it has its own challenges. I can say that we know the owners of Telepizza, and yeah, I mean, you can also see that the number of stores got lower. And then there is also Biesiadowo. There are also some other smaller chains. On the previous webinar, I got a question, and actually, I got a question now also from Michael, whether we consider buying some of the smaller competitors to accelerate growth. I was exactly getting to this point, so thank you, Michael, for the question. We were more skeptical before, but now we see that the competitors suffered and were bleeding over the last months. And if we have a good opportunity that we can, it's based on the price. I mean, we are a large shareholder, and if we think it's cheaper and faster to buy, we'll go and buy. If we think it's better with the rollout, we'll start with the rollout. And there was also a question, and I will address it. I will address it in the next slide. But about the growth opportunities, and we see that there are some M&A opportunities, and we started already discussions if we can grow the business significantly by acquiring some of the ailing competitors, we would go for this, because we think it makes sense. So this was about the smaller competitors. There was also about the market developments, about the COVID support. Yeah, what was the COVID support? The COVID support was not that strong in Poland. I mean, there was a support for micro enterprises and for large, but not for the middle ones. So as a result, you know, many of those networks did suffer heavily. Pizza Hut used to, just to give you an idea, they used to run this pizza festival for, I think, 2 weeks, sometime in January, and now they started this beginning of September. That continues until the end of continued, I think, until the end of October. That shows that they are desperate to get clients. So our competitors did suffer. Telepizza shrank in terms of store numbers. So there may be opportunities there, but it's still early on, and we will consider what's best for the business. Now, going back to the question about, there was a question about store growth, and this came from Nick. This was actually the first question. So Nick, sorry for keeping you waiting, but I wanted to address this question here. We were also inspired by one of our shareholders, you know, to show you this graph, or this sort of numbers. We are not allowed to show you the final figures because our lawyers don't allow us to give you any guidance on the future, because it's a bad thing. But we wanted, but you can do the numbers yourself, so you can easily guess or calculate it yourself. The store growth, as I mentioned in July, we see the potential for store number in Poland between 5 to 1,000 stores, and this would come out of the calculations that you do here, and it's your call how many you can see. We see as the big shareholder that our stage of growth and responsibility for the company is to get the business from up to 250 stores. So we think that this can be achieved within 3 to 4 years, and that is our plan, and this is what we are working on. And this can take a form of the organic growth or the M&A. I commented on the M&A. On the store openings, we also see, because of the ailing competitors that goes down, we see more and more locations that are available to us. And actually, we are already getting approached by people who would like to open on the Domino's brand. So it was also quite interesting, because when we started, me and Piotr were talking to sub-franchisees, they were complaining a bit about the developments before, but now we see an appetite from them on opening new stores. So it's a great development over this 10 months that we managed to change also the atmosphere and the tone of discussion with sub-franchisees. They want to open more locations. They come to us with already identified locations, and in those cases we would be open to various mechanisms. In some cases they would like to open, they can afford to open this themselves. We don't need to invest, but in some cases we would agree to co-finance the new opening. If we see that this makes a lot of sense, then we would support them. And this is one of the ways to grow the scale of the business. Also, Piotr mentioned on the slide regarding the developments that we have worked on the sub-franchisees, and it's also now part of our HR development plan, that the best performing employees, managers, will have a chance to buy the store from us, and then we give the franchise to them. As you may remember from July, we want to rely on the sub-franchise stores, but this is a process. We wanted to see the performance in October, November now, how it's to see how the business really looks like, not to make mistakes in the new openings. So we want to start the new openings from 2022. These numbers show the store per capita growth, so we are looking at that as well. These are the metrics. We would be opening mostly addressing, because someone asked what Nick asked what KPIs we would use to measure store performance. Well, we cannot dive into very details because surely competitors are listening, but of course we look at sales and number of checks, the average check, especially now in the environment when the inflation is going up. We are looking at the average check amount, because that helps us to cover the delivery cost. When you, I think I have addressed all the questions. If not, then feel free, everyone, to shoot questions. I'm reading them here. I think I have addressed all of them. Well, on the opportunity, so store count, and the other is store profitability. We use the benchmark of Domino's Pizza Enterprises, Domino's Pizza International, and Domino's Pizza UK, just to show where they are. Our ambition is of course high, but we don't expect that we'll get to those levels in the short term. But there is no reason why we shouldn't be getting there over time. UK, as some of you may know, that the UK figure is a bit impacted by the VAT break they got from the government. So that's why EBITDA is larger. We didn't get much of help from the Polish government, so we are relying on ourselves. But anyway, those numbers show you the levels where we should be getting to. When you look, I mean, normally people would think, okay, Poland has a income per capita which is much smaller than the average EU. However, if you decompose Poland into the big cities in the countryside or smaller towns, then you'd see a much different picture. I think when you look at the Warsaw statistics, Warsaw is above the EU average. And Warsaw, and if you look also at Wrocław and Krakow and the three cities and so on, this is probably the size of I don't know, Austria or something, like a small size country. Warsaw metropolitan area has 2.5 to 3 million inhabitants. I mean, the estimates say. So we should have also an ability, because the consumer purchasing power is there. For those who've been to Poland, you see that's not sort of much different to other European cities. So people do have similar consumer habits. So as our aspiration would be to go towards those store profitability, but of course over time. And if you do the mathematics multiplying the store count and the profitability, then you see what is the goal and where we intend to make money. There's a question from team about the comments regarding sub-franchisees. Historically, why did the company struggle with sub-franchisees growth? Has some change in terms of potential profitability of stores? Okay, so I will address it here because we have only one more slide. So when we merged the two networks, we could see that networks were overlapping. So in order to be able to design the most optimal network of our stores, we decided to buy back some of the stores from sub-franchisees, because that allowed us to redesign the delivery areas in the most optimal way. Those stores were not doing well, but the history also of Domino's, it was not doing so well too. But when we commented about the 6 months performance, I mean, you can see clearly that we're not happy with this, and there was a number of things. But indeed, what happened, we made a huge turnaround of Domino's Poland, and this is a different business now. So it's much better business, much more efficient. And when you look at the statistics, like for like basis of our sub-franchisees, the ones who stayed, they are really growing. So they turned back. They turned from being negative and a little bit sort of well, not happy, a little bit disappointed, to be quite optimistic. And we had a sort of a get together with them a few months ago, and you can see that the sentiment changed, and now they all want to open more stores. So I think this is a team is asking what was the struggle with sub-franchisees growth. I mean, it was many of those factors. I mean, the brand recognition, the e-commerce platform. We mentioned that we have a new e-commerce platform. We actually Starting from August, we have a position of a revenue director. So a person whose main responsibility is to look at the customer behavior in our e-commerce, to be in touch with customers, to design offers, to introduce new products, to discontinue some offers, and that all helps. Every single small thing helps. We have also centralized call center. It used to be that people would pick up phones in the individual stores, and this would distract them from doing pizza and servicing clients. Now it's all centralized, and we are also improving upselling. So now it's much better model for our franchisees. I think some of them show much better performance than we do, and that's good, because I mean this is our future. We want our franchisees to get better and better, get stronger, and we'll do our best to support them, because then we can grow the business together with them. Well, I hope I addressed that question, team. But if not, then please add another sub question. And then I would also go to the outlook and the last slide, or maybe there's one information missing, but I will cover this as well. I also allow myself to comment a little bit on this, because some of those points are views and subjective views. So I mean, as a non-executive and also representing the shareholder, then I think I can allow myself to comment on those. Especially on the first point. I mean, we did spend quite a bit of time on this webinar discussing the dynamics of customers, and whether people are back to big cities or not. And some of those trends are visible, and some of those are our judgment. So our judgment and view is that the tourism will recover. Piotr mentioned, I think it was Piotr mentioning that how the number of tourists declined in Warsaw and Krakow. I mean, if you have not been to Poland yet, if you want to come, go to Krakow. Krakow is a really nice place. Warsaw is a busy place. There's a lot of business. It's good to live here, but if you want to go sightseeing, go to Krakow. However, these days, we used to have a lot of traffic from UK, but those of you who live in the UK know that the travel restrictions were quite tight. So we did suffer, and we continue to suffer. However, our view is that this will change, and gradually the tourism will recover. Probably COVID will stay with us for some time, but people will be more and more vaccinated, and we just accept that there is a risk like COVID. So our bet is that the customers will be coming back. And then our performance will be even better, because now we are doing quite well when you look at October. Even without these people. Second point about the customers is that the hybrid office working mode will continue. However, generally, Poland is benefiting a lot from this sort of relocation of some of the back office function. We have Standard Chartered, we have JP Morgan and equivalents building their sort of back office functions here. You may be familiar with this nearshoring trend, especially after the COVID lockdowns. If people outsource some services within a group, they don't want to do it on a big distance because it's difficult to get there. So Poland is actually benefiting. So we see that the offices are being constructed here. There's more people working. So generally, we think that this will be a favorable trend. Better value proposition. Piotr mentioned about the delivery times. We have the largest network that should help us to be the fastest, and we think that the value to the customer, that's also a cost item, that's also a convenience. So this we will continue to do that. On the new openings, we want to focus mostly on the delivery businesses, but we want to keep also the dine-in, like flagship stores that I mentioned before. The digital marketing, we are improving on that. We have a new platform that was launched earlier this year, and now we are playing with it. We have the engine, and we are just now optimizing this and using different tools just to get more customers loyalty, just to improve our offering, to improve the customer journey on the website, and so on and so on. So that we see benefits of that in October, and we expect this to continue. The last point is, I have not seen a question about the inflation. There was a question about the supply chain. However, the inflation rate that is affecting everyone in the world, or most of the people, especially in Europe, with the energy prices, gas prices, but all other commodities, that affects all of us. We think we are quite well placed because we are the largest. So our pricing is probably the best. We are negotiating terms rather than being the simple price taker. However, the trend is not stoppable. What we have done is we have increased prices. In Poland, pizza is still sold on offer. So you get the second pizza for 50%, or you get Coca-Cola for free, and so on. So this is also an instrument we have at hand to deal with the inflation, and deal with the prices. The third instrument is the minimum order for delivery. We can increase that also to cover our delivery cost, which is also growing, as Piotr mentioned, about shortages of people. And the fourth instrument, which is connected with the third, is a delivery charge. We have not yet introduced delivery charge, but we see some our competitors do it, like Telepizza, and in some locations they do it. But most importantly, food aggregators like Uber Eats, like Glowon, and equivalents, they educated the market, and customers are more and more used to see delivery charge. So if we see that the trend continues on the inflation, that this is one of the instruments we have in hand, and we do consider this. If competitors listen to us now, that's a good that's a good part. So don't be shy. Introduce delivery charge, we will follow. This is something we are looking at to improve our profitability. Like Uber Eats is charging 5 zlotys, I think, per order. We have I don't know, hundreds of thousands of orders, of millions per year. So that could be significant. Store openings, I commented on this a little bit. We want to start in 2022. This is for a few reasons. One is that we do not exclude opening stores still in Warsaw, in the places where we are dominant, because we already now see locations where the demand for our service is bigger than what we can deliver. So in those locations, if we see that it makes sense to open a new store just to improve the delivery time, customer experience, because this is delivery time, we can do that. We opened actually one store in Warsaw this year, and then we may still look at this. But we see the opportunity is also with places outside of Warsaw, and those dynamics of like-for-like sales make us confident that this should be very successful. Those growth rates are much above Warsaw. One before the last big comment is about the VAT. You may remember that in the admission document we discussed the potential recovery of VAT. There was a dispute that Dominium had with the tax office, and the Dominium decided to pay all the disputed amounts, so the money has been paid. But we continue to dispute it. And we got a positive ruling of the Supreme Court in Poland, and now the tax office has time to appeal to that. But I don't know, it probably expires this time to appeal within maybe this or next week. So hopefully we will hear back that they have not appealed, and then in that case there will be money flowing our way. I think the expectation would be, I'm just thinking not to misguide you, but this would be sizable amounts. I think it's like £1 million that could flow our way if all those positive decisions are confirmed. It will be a process because we got the ruling for 2 years, right, Gosia? Yeah,
sorry, had to make my microphone unmuted. Yes, this ruling is for 2 years only.
Yeah, and then overall it was 5 years, and maybe it's more. The last point to mention here, it's sort of an elephant in the room, and we didn't put it here on the slide because we are still working hard also overnight to announce this accelerated book building that was announced just before this call, unfortunately because of a lot of admin and legal work that delayed us. But we announced accelerated book building that started today and will continue today. This is £3 million. This is to support the working capital, but also help us grow. The new store openings, I mentioned that we wanted to see the true performance so that we can make proper decisions on where we should be opening new stores to see the demand. We will have, for example, some stores next to university campuses. So we wanted to make sure we find the perfect location. But secondly was the capital available. The things took longer than anticipated. And I have to admit that the third quarter we were not so happy. Well, we sort of were more ambitious than it was. I mean, I explained the students and the dynamics, but we anticipated this speed up and growth would be faster. Now we think we have a good sort of run rate, and that's improving. We will generate positive cash flow, which should support our rollout. But in addition to that, to accelerate the growth, we are also raising money. We are also contemplating a TV campaign. We know from other markets that this was also something that helped them to grow business. We are looking at the neighboring market of Germany, and the CEO there makes an outstanding job in opening more stores. They are also supported by TV campaign. So we will learn the best practice. We get a lot of support from Domino's International. So it's exceeding our expectations, the quality of the cooperation. So we may also decide to go for TV advertising based on this capital raise. But we are looking at every euro that we have, and we will use it in the best way. Or we think it's the best way. Also, maybe consumer loyalty programs. Again, Germany just introduced that, so that's also another thing we are considering. Well. So that's it. I wanted to give you this last part a little bit sort of from the shareholder perspective, not from the executives, because some of those are views. But if you have any more questions, then I would be happy to address. I try to answer question by question. But if you have any other summary kind of notes or comments, questions, then please don't hesitate and ask them now. We'll do our best to address.
Przemek, thank you very much indeed. I think you indeed, as you quite rightly point out, you've answered all the questions submitted by investors today. So thank you to investors for taking the time to do so. Of course, Przemek and Gozia and Piotr, if any other further questions do come in from investors, we'll make those available to you for you to review after this meeting has ended. I know investor feedback is important to you as a company, and we'll shortly redirect investors to give you their thoughts and expectations. But just if I could ask you, Przemek, for a few closing comments just to wrap up with, that would be great. Thank you.
Thank you, Mark, and congratulations on pronouncing my name. It's not that easy, no? I think we like to think about ourselves and our Domino's Pizza Poland that it's a complete product. We have a machine, and now we are fine-tuning the machine. I think it took us 6 months to build it, and this was a huge role of executives, and this was done on plan except for this IT. I think the third quarter we were more ambitious than the results, but we explained why. But we are very encouraged by performance in October. We see that the customers appreciate what we have proposed to them, and then we can be doing better and better. We are quite ambitious about the store growth, the store count growth, and also profitability growth. We are now raising capital, but we also are very sort of disciplined not to in terms of we look at every euro, so we're not raising much money, but we think it should be sufficient. We would like to accelerate growth starting from 2022. We think the market is there. We have a good team. and we will be improving on the top line, but also on the cost side, the margins, and the support the business going forward. I was a bit distracted by a question from Alan about the borrow rather than further dilute the shares again. Yes, Alan, that's also on our agenda. However, as you may imagine, the Horeca was not the most sort of favored sector by the lenders. Now, so during the COVID days, so that was not available to us. But yes, that generated the plan. That's why our capital raise is so modest. We don't want to raise too much, especially me as also representing the shareholder, and we don't want to invest money if it's not needed. So we'll look at the most optimal funding structure. For the time being, we do not anticipate any additional capital increases. If we see if we see a sizable M&A opportunity, and we conclude that makes sense, then we will do it. We, as a largest shareholder, will participate in the current capital increase. We support the business, but we are looking, at the sort of the return on the investment, and for the time being, we think we are done. So I think this is where we are. We want to keep this dialogue with you. I mean, we got a lot of positive feedback, and we feel encouraged to continue with this. So we will dedicate resources to have another session like this in a few months. Let's see what next months bring, but maybe we do some trading update sometime in the second half of January. We will publish the information about it with a proper notice, so then you can get ready for that, and then you are not surprised.
That's great.
I think it's all from us now.
Thank you very much indeed, Przemek, Gozia and Piotr, for updating investors today. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team could better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of DP Poland, we'd like to thank you for attending today's presentation. That now concludes today's session, and good morning to you all. Thank you.